All right. Thank you so much for coming out. And tonight we're going to be talking about construction loans. It's actually kind of a great topic to have because some of you might be like Tammy, who already owned her own land and wanted to consider building on her own land that her family had given her. And she really wanted to understand the steps necessary to help her get across the finish line when it came to building her own home. And these are actually very good and important questions for people to consider because there's a lot of benefits when it comes to building your own home on your own land, especially if the family's given it to you. But maybe you might be like Mary Catherine and Roger, who were trying to build a home and they were trying to figure out how to do it since they already owned a home and they were living in the home at the time in which that was happening. So we're going to be discussing some of that here tonight. But what I'd like to know is more than anything is I'd love to hear your thoughts on what you're trying to accomplish tonight and what you're trying to hear more about tonight, because that would be important for me to make sure that I cover that. So you can either unmute yourself and share what you have, and I'll make sure and I address it, or you can send it in the chat, and I'd be more than happy to go ahead and address it if it's in one of those two places. So anybody with any thoughts on what you're trying to understand or accomplish as you're going into this construction loans? You're on mute, James.
Hi, Chris. Good evening to everybody. Chris, I know for me, I just wanted to get an idea of how the actual process works. I've
Okay.
always had an interest, and recently I had a prospect of mine that said they were interested in buying the land as well as building their own home. So I wanted to
Okay.
be able to be at least conversant in the initial meeting about how that process works, and then know that I have a valued and trusted resource where I could refer them to and they'd be taken care of.
Okay.
And then sometimes I hear certain companies say that I can do that with one loan. Then I hear about settling twice. So my hope today is to leave here with better clarity about the process and how Churchill Mortgage is unique in their process.
Okay. Well, we'll certainly address those items for you. Any other items that anybody else would like to have addressed? All right. Fantastic. So thank you so much for that. If you do have anything else as it comes up, don't hesitate to put it into the chat or unmute yourself. And it looks like it's going to be a fairly small group tonight since we're already going and nobody else has joined in. So this will be a great opportunity for you to get in and ask some questions as we go along if you'd like to go down that path. So, how does construction loans work? What are your options? There are actually several different options. There are two main tracks that you can consider when you're looking to build your own dream home. And some of it's going to really depend on how you want to do this. For example, here's what I mean by that. When you're getting into building a home, you really do have two significant options that come about when it comes to this. One of which is selecting a builder who owns the lot and already has that, which most people are fairly aware of how that works. And what they do is, in essence, they go to the builder has it all set up, they own the lots, and in essence, what they're going to be doing is they're going to be going into the process of building this home with the builder present, and that's a fantastic way to go. The builder pretty much handles the whole thing. While that's part of what we have as far as building, that is not the entire conversation as far as what we're going to be talking about tonight. We're actually going to be talking about building on your own land, which is a slightly different concept. And so the turnkey option is the one we just got done talking about, which is going to be that I just got done sharing. And that is where, in essence, the builder owns their own lot and they will contract to build the home for you. And you just walk into the neighborhood and then they set you up, in essence, for, building the house on the lots that they own, whether it's in a neighborhood or out in the country. Typically, you're going to give the builder at that point in time a deposit. That deposit is usually 5 to 10% of the total home price. And that really does vary by the neighborhood. I know that when I was working for one of the local builders, they required a 10% deposit. And then, depending on customization, they would, in essence, possibly add more to that. Now, the way that it works for the turnkey option is in essence kind of like what you're familiar with if you go into any one of these neighborhoods, is that the builder is going to go ahead and finance this. And then what's going to happen is that after they're done financing it, they're going to, in essence, turn around and go ahead and you're going to, at completion, you're going to be taking over that loan. And that's a great way to go, but that is the most common way that most people do understand. What we're going to be talking about tonight is more of a construction to perm option, whether it's on a lot that you already own or whether you have to find the lot and then contract the lot. It does get a little bit more complex in this case because you're not unlike a builder who is associated with a neighborhood. This is where you actually have to find a builder, and then they're going to go through the process of building this home for you based off of the plans and specifications that you put forward in your contract with them. So the contract is a little bit more complex. It does take a little bit more work up front in order to get it done. But it is a beautiful way to get set up, especially if you found that perfect tract of land, whether it be 5, 10, 20, 100 acres, and you're looking to build on that, or maybe you found an infill city lot and you want to go ahead and do that. These all work for that. And what we would do is, in this essence, is as you pick the builder, is we would get a construction loan to help you build the home. And then once the home is 100% complete, we will convert the loan to permanent financing. And this is what we're going to be focusing on tonight. We're going to be spending a little bit of time discussing exactly what that construction loan process does look like and kind of be able to help set that up. And that, like you mentioned, James, there are one-time closes and there are two-time closes, both of which do have a variety of benefits and drawbacks because each lender has a slightly different approach to how that works. And so we're going to address that and we're going to talk about how we have it set up, and then we're going to compare it to what some other people have when it comes to that market. And I'll just kind of share a story real quick about how that works. Is because many times what I found is that most people don't necessarily want to pay closing a variety of times. But what happens is when you buy the lot, if you take it down ahead of time, you're going to have the closing on that. If you do the construction loan, you're going to have closing on that. And then if you get the permanent loan, you're going to have closing on that. So you have three sets of closing if you're doing it that way. Not necessarily a bad way to go because if you get into a certain price point, that's going to be a required way of doing it. But if you're doing it with a general situation that's in what we call conforming limits, then it's very likely that you wouldn't need to do that at all. But we're going to talk about that very clearly. So first of all, in the construction process is you do need to find the lot or and the land and buy it. Now, that doesn't mean you can't do this with the construction loan. The construction loan can handle the purchase of the land and go towards purchasing this land as well as contracting with the builder at the same point in time. These are some great ways for you to get set up if they want to go down that route. So you don't necessarily have to own the land up front in order to be able to go down with a construction process. The land can be purchased separately. It can be owned already and maybe a family inheritance, like we were talking about when we were talking about Tammy. Or it can be something like what we dealt with Mary Catherine and Roger, who wanted to build on a lot that they had as an infill lot, and they ended up finding it and buying it and going through the construction process with that as well. So the construction process is you can find the lot and go through the lot initially and buy it outright. You can finance the lot, or you can go ahead and include it in the construction loan. Now, keep in mind that if you do go and put it into the construction loan will take a little bit longer if you're buying the land. So if you're going through the process of contracting on the land, you need to make sure that you set it up so that you know how long it's going to take for the builder to provide whatever situation it is that they're going to need to be providing in order to get that done. And so we'll talk a little bit about that process here in a little bit, because you'll find that the land loans, you do have a period of time where you have what's called due diligence. And with the due diligence, you get to study the land to make sure that the land is going to work for the septic, for the utilities, for the well. All that stuff is stuff that you get to study up front. And if you're not connected to city water and sewer, that process can take a period of time in order to get that set up. So finding the lot and finding the land is going to be extremely important. And also understanding what kind of easements you have to get into this land. I've had people look at property. There was a fantastic piece of property. I actually looked at it and thought, wow, this is a really nice piece. I would like to have this piece. It was out in Powhatan, and it was out a ways past the park out there, the Fighting Creek Park. The problem was with the land was it was completely landlocked. And so that was a big issue because there has to be some form of ingress and egress so that you can get to the land. Now, you could have probably, it probably could have been worked out with a neighbor somehow, but that was going to be a significant process through to get there. Now, the land was wicked cheap. It was really a good price, but that was really going to be a problem when it came to the land. So you have to, when you're looking at the land, you really do have to look at more than just the land itself. You're going to have to look at it from the standpoint of how close am I to the road with this? Because utilities do cost money to take out there, and Dominion Power, at least in the Virginia area, is going to be charging by the foot to bring utilities, especially if you're doing it overhead or underground. If you're going underground, it's significantly more expensive. So looking at utilities is a big deal. Understanding whether your site is going to perk is going to be a big deal as well. And then understanding if you can get a well out there is a big deal as well. Now, going into the loan programs that are available, these are actually some really big and important pieces that you need to understand and be and effectively be able to manage because we do have a variety of loan programs that work here, especially with what you're talking about. This is going to kind of start with some of the stuff that you were talking about, James, because you can see here that there are one-time and two-time closes in here, and some of it is going to be coming up to how you want to do this. Now, generally speaking, we try to encourage a one-time close. Now, a one-time close, what that means is that if you're taking down the land or you're taking down other items like that, that in essence that you have the ability to take the land down and smoothly go ahead and go right into construction. Now, if you already own the land, that's fantastic. The land is used as collateral if you already own the land. So what that means is it applies towards the down payment. So if the land is free and clear and it's worth 100,000 and you're building a $500,000 all in, you already have your 20% in there. And so that's perfect when it comes to a situation like that. But if you don't have that, that's not a big deal because you can do up to a 95% loan to value on these purchases. And that's a fantastic way to get set up when it comes to this. But you can also see that FHA will also do 96.5 and the veterans will also do 100% financing. There are some specific scores that you have to maintain as you're going along with this, but that works very nicely when it comes into making sure that you have all this set up to be able to buy this house, this land, and go ahead and build. The great thing that is fantastic that works very nicely with the construction loan programs as well is that most of the time what we try to do is make it easy during the process so that you're not making double payments. So let's talk about how the construction loans work so that you're a little bit more familiar with what this means. What this means is that the construction, there are two separate loans when you're getting into construction. There's the actual construction loan, and then there is the takeout loan. We call it the takeout loan. It's the loan that most commonly every other lender is we call the permanent loan, so that at closing you have that loan that would traditionally go for the next 30 years. Now, when you're doing a one-time close, in essence, what you're doing at that point in time is you're modifying the loan so that what happens is that you're buying the land, you're buying, contracting with a builder to do the work, you go through the process, you deal with a construction loan, and then at the end of the construction loan, all they do is they modify that loan, go down to the county courthouse and staple the deed and the amortization table for the one-time close. It's very simple, saves you a ton of money when it comes to closing costs. There is a filing fee that goes with it, but it's significantly less than what you would find if you were dealing with or had to consistently pay for a two-time close. Now you can do a two-time close on these in the conventional, in the what we call conforming limits. You can do a two-time close. Where would a two-time close come in? A two-time close would come into play if you did a tremendous amount of upgrades, and the builder is, and your construction loan is no longer covering it. And here's the reason why I say this is because with a construction loan, especially a one-time close, it is what is called a closed loop loan. With a closed loop loan, what that means is that if you get into change orders with the builder, you are no longer you're paying for those out of pocket if there's nothing in the loan in order to address that. Now, typically, we try to include a contingency plan in this. And so that means that if the home purchase price is 500, we're going to ask you to put 10% in there in order to have some form of a contingency plan, just in case, hey, you like the selection in the kitchen, but the kitchen could get upgraded and you find something that you really want to do. Or let's say, God forbid, you get into digging the foundation and you find out that somebody buried a 1967 Chevy Impala in the backyard of where you're planning on building the house. Well, guess what? That Impala is going to have to come out of the ground, and it's going to take some extra work for you to dig the foundation down low enough so that you can go ahead. Now, hopefully the mob didn't bury it there, but you get what I'm getting at. All of a sudden, now you're dealing with a situation that you're going to have to do some additional work. That's why that contingency plan is in place, so that you don't have to come out of pocket. Now, if you don't use it all, it gets applied to the principal. You can do a recasting, it lowers your payment, all that stuff. It's a great way to go when it comes to that. That allows you to do a one-time close because you can build some of these extras, these different change orders into the construction piece, and then you can move forward with something like that. Now, if you extend way past that contingency fee, that's where the two-time close comes in. Now, you're paying some extra closing costs, so it doesn't necessarily make a whole lot of sense to do that if you don't have to. But what it does with a two-time close is it allows you to roll those extra costs that you may have paid out of pocket into the final loan. Because in essence, what we're doing when you do a two-time close is you're refinancing the first mortgage, which is in this case is the construction loan. Okay, so that's where the two-time close comes in. Most of the time, we try to avoid doing a two-time close just because of the not the complexity, but the cost. Okay. Now, with a construction loan is an interest-only loan that is designed to be for a very short period of time, meaning the construction phase. And we really want to know from you how long this is going to take. And so this is extremely important for us to get in with a builder and understand some of those details with a builder. Now, we've addressed some of the one-time close situations that you can see right here, and you can see that we can do it with FHA. Oh, not a very good drawer tonight, but that's okay. We'll clear this in a second, and you can see that the one-time close is available in any of the general ones. Now, if you get into the jumbo, and that would be anything over $816,000 loan amount, you need to have a much higher credit score. You can see that right here. Okay, you can go up to a much higher construction loan, and you can do an LTV or a loan to value up to 89%. Now that's pretty good because most jumbos will require that you do at least 20% down. Now that will affect some other pieces to this, but that does give you the opportunity to see what you're kind of dealing with when it comes to building these homes. Most of them are going to be, from my perspective, most of these we're going to try to encourage them to go to one-time closes because a one-time close is certainly going to provide them with a savings when it comes to closing costs. Whereas a two-time close is going to be pretty much mandatory when it comes to the jumbo loans themselves. Okay, now going a little bit further in this, here's kind of the construction process so you can kind of see what it is that we're doing. Now, before you go out and lock in land and do all these other things that you're trying to do, it's a really good idea for you to go ahead and get fully pre-approved and fully understand what it is that you're trying to accomplish here. And this is so important. I can't understate the necessary part of getting pre-approved. And then this is kind of the process of what we're going to be doing with the loan itself. And so once you've identified the land, in essence, you've decided that you want to go ahead and start building, that is typically going to be in this area right over here. This is where you're going to be start building right over here in this area. We're going to give it a little heart because we all want to build a house and we all know that we want to build a house. We can throw an arrow through it if you want to, but this is where we want want to build this house, right? We identify that, we start going down the process of understanding what it is we're trying to do. And right here, we have to start getting some budgets from the builder. Now, why is it important for us to start getting budgets from the builder? It's extremely important for us to get some budgets from the builder so that we can begin the process of understanding what these numbers are really truly going to look like for us. And this is, it can be rough numbers. It doesn't have to be an exact number, but we do have to have some good, solid, rough numbers. Maybe they give you a price per square foot. Maybe they give you a price. Now, that needs to include everything. We talked about that. It's going to have to include the driveway. It's going to have to include the utilities. It's going to have to include all the stuff to get us across the finish line. Once we have that information, now we can go into the application process, which is where we're going to be going in and trying to understand what's happening with getting the house set up and making sure that we can get the full pre-approval done in this process. And we're going to look at credit, income, and assets. We're going to do all the hard work up front to make sure that we know what it is that we're getting you into. And then once we have that done, we want to start solidifying with the builder the budget process. Now, this is extremely important because now we're going to start refining this process a little bit more and putting a little bit more meat to the skeleton. We're going to be asking a little bit more questions and we're going to be asking the builder to define some things. Now, this is extremely important because as we do this, here's what we found is builders are tremendously good. Builders are tremendously good at doing their job, but many times they're not tremendous at the paperwork side. And so we have to help them as we go in the process with this. So the first thing we're going to do is we're going to start identifying that budget, and we're going to be starting to break down some further numbers on this and making sure that we know what it is that we're getting into when it comes to buying this house. Now, one step further, we're going to start doing what is called a project review. Now, the project review is something that we're going to be doing internally. As we get into this piece internally, what we're going to be doing in the project review is reviewing the documentation that the builder has put together with the budget, but we're also going to have to make sure that the builder is going to be capable of building this house. Now, that sounds counterintuitive, but here's what you got to know when we're doing this is the whole point behind going through the process of vetting this builder is we want to make sure that this builder is going to be there longer than the warranty because once we've done the approval, once we've underwritten the loan, once we finalize the loan, the weak point is now the builder because some builders are great at their craft, but they're not great at managing money and they're not necessarily great at paperwork. I don't want to throw everybody under the bus, but we will just want to make sure that you and your client are not the ones that are suffering from this. So this project review will play a big role. All right, before I go a little bit further on this, are there any questions that may have come up since the last opportunity we had for questions? Anything that before I keep streaming on? Go ahead, James.
Does Churchill have any identified approved builders already that they've worked with?
We do have some that we have worked with in the past, and certainly some in the Central Virginia area that we can certainly connect with. But every year we have to re-up their paperwork, and so we're getting to the point where the paperwork will have to get re-upped again for everybody. And in that process, here's what we're doing: is we're just looking at references to make sure that they know what they're doing. Number two, we're going to be looking at financials to make sure that they're not robbing Peter to pay Paul. And then number three, that they have a reputation in the market, in the marketplace, and that in essence that we can call some of their trade vendors and know that they have paid that their people on time. Because literally, I mean, we can't afford to have a client not get to the closing line on one of these because it really gets messy if we don't. But yes, we do have some.
Awesome. My next question is, what are the time frames in between these particular stages? And we've
Time frames we
identified
can
the
actually.
builder,
Hmm.
and then we have application, then it went to budget review. And
Hmm.
I guess my question was, what are the time frames in between those stages? 1 to 2 weeks, week three, this is what's taking place, that type of thing. I don't know, it's 5 to 7 days, you know what I mean?
So that's a great question. And some of that's going to come down to the builder because a builder can sometimes be a little harder to predict. Some builders are
Mhm.
super Johnny on the spot, and once they get going, like for example, I have a relationship with Kevin McNulty with Lifestyle Builder and Developers, and he would probably get everything you need and get us to the to from soup to nuts from beginning to end. It would be 60 to 90 days or less. But I've had some builders that take 60 days just to get through the budget review piece because they're just not as organized, or maybe they just don't have a team. And it depends on how rural you're going, you know. So here's what I mean by that. Out in Cumberland County, it's a little harder to get people to there. It's more like one man bands out there than what you're dealing with if you're dealing in some of the other counties that are a little bit more closer towards the metro. So this timeline that you're talking about right here in this area and then going to here, once we get all the paperwork from the builder, my team has a commitment of getting it done in less than a week. And so it's not a matter of that. It's just that sometimes the builder is extremely busy because he's doing a little bit too, quite a bit. And so it's hard to get them corralled. The harder piece that I have found is getting these pieces together in a way that is actionable with them. So
What role does the realtor play in the go-between facilitating getting that paperwork done? Meaning, if my clients have identified a builder, is there a package that I could get from Churchill to present to the builder so that they could be working on that? Or is I just link you two together and you guys talk? How does that work?
So that's a fantastic question. I've had this question multiple times before, and that's really going to be something that you need to negotiate with a buyer and also with a builder. And so and I'm not trying to evade your question, but here's
No.
what that means. Is generally speaking, unless the builder is willing to pay to have your services there or the buyer is willing to pay for your services, most of the time the real estate agent is done with the lot. And so you have to now, I have to tell you that I have a lot of builders like Kevin McNulty with Lifestyle Builders and Developers. He sees a lot of value in having the agent involved in the process because it helps corral the buyer in some cases. Okay. Now, not every builder is going to be like that. And so this is a little bit more of the wild, wild west when it comes to that. But you do have to have that negotiation done with the buyer and also with the builder to see how that would work out as far as the compensation piece is related to that. Okay.
Okay, so I guess my question and I hadn't even really thought about the compensation aspect. I guess I was more thinking of facilitating a builder that you were unaware of that the buyer may have brought. How do I facilitate them getting their paperwork in?
So that's a really good question. I have a team who jumps on this. They're fantastic at what they do. And what they do is they send the builder the package and then they follow up with the builder periodically to make sure that the builder is able to provide us the information. And it's simple information. It's like we send them a package and a list of 5 items. We want a copy of your license, we want a copy of your insurance, we want a copy of your financials to make sure that you're okay, that you're not, and we're not doing this because we want to stomp on their profit. We're doing
Hmm.
this because we just want to make sure that they're not going to disappear in the process.
Yeah,
That's
that they're soluble. Okay, understood. Thanks. Thank you, Chris.
okay. Fantastic. All right. Any more questions? Otherwise, I'm going to keep moving. All right, let's keep moving then. All right, so once we've done the project review, which is right over here, in essence, we're going to go to the next phase, which is we're going to go ahead and I'm going to create a little heart right here because this is really the next step in the process. Is what we're going to be doing here is we're going to be locking the loan. Now that means that the buyer, or in this case, the buyer or the borrower is going to be moving forward and we're going to be getting the loan done. Now, the great thing and the great news with this is that as we do this information, as we pull this through, you're going to see that there's still stuff that needs to be done when it comes to be working with when it comes to be working with the buyer themselves as we're going along. There's still going to be some work review that's going to be happening, and there's still other things that are happening down here in the bottom. We have a builder team who's going to be working on that directly And while at the same point in time they're doing that, we're going to be going up here and making sure that we're getting the loan process down. Now, the loan process itself doesn't work independently from it, but it works side by side with it. So what we're going to be doing there is we're going to still be doing the typical traditional loan process up here at the top, while at the bottom, the builder team is going to be working on the review. And provided that the builder provides us everything with it, all this is going to line up with the final underwrite so that in essence we can go ahead and get the builder accepted, the project accepted, and then the final underwriting done simultaneously so that we can streamline right into closing, and then right after that we can start the construction on the house itself. Not always perfect like that because people are people and sometimes builders take a little bit of time to get things done. But I would have to say that in most cases, this works very well. Now, the final builder acceptance and project acceptance, we're not looking to see if they're putting aluminum or vinyl windows in the house. We're going to be looking at it from the standpoint of, do the numbers seem to make sense from what we've seen in the past, and make sure that we're not getting into a place where people are going to have a hard time. Now, once that is done, then once it's closed, they can start construction at that point. Now, in this final acceptance and project piece that we're talking about right here, there are some pieces that end up coming up along the way because we want to, as we're finalizing this stage right here and getting ready to go into closing, right here in this space right here, we want to make sure that the budget is clear, that the builder knows what his draw schedules are going to be like, and that everything is set up so that when we go into closing, there is no assumptions being made. Everything has been documented. Everybody's on the same page. And then after that, then we can start getting into the construction and commence with that as we go along. Okay. Now, the construction process is you want to get your house print plans done very quickly. That gets done during the project review. We want to create the budget from the plans and specs. We want to sign a contract with your builder. All that happens in the phases leading into the piece where we're talking to the builder and we're working through the phases with him. So that all that's going to happen over here in the project and budget review and work review, and then be finalized right here when we get into the phase where we're dealing. So these different phases are going to streamline together. And then right here is where all that stuff is going to be on the next page, is the ones that we're going to be talking about right here um, as we go into this piece where we sign the contract with your builder. All that's going to be done at that point in time. That way we can move forward seamlessly into the construction. Once that happens, we're going to submit the builder and the project for approval to your lender. We're going to order the appraisal. These are all parts and pieces of a normal loan process as we're going to get into this. And then as we're going across, you're going to see we're going to look at credit, income, and assets. We're going to look at the builder. We already talked about some of this and how this works. We're going to look at fixed cost. We're going to be looking at the variable cost, because here's the thing is fixed cost, builder knows what his fixed costs are, but many times we're going to find out that he allows some allowances in there, and we want to make sure that we have a good cost breakdown for each one of these. Not because we're trying to step on his profits, but because we're trying to make sure that the person that's doing this gets it done. And many times the builder will put some allowances in there. For example, he doesn't know which kitchen these people are going to be picking out. And so we want to know if it's a $50,000 allowance, if that $50,000 allowance for the kitchen covers appliances. Does it cover knobs? Does it cover faucets? What does it cover? And so these are all parts and pieces of what we're going to be asking for them to define as we get into this process right here. Then we're going to get into the actual construction process. Everything's been approved. You get the next piece right there, which is going to be the loan, and then they're going to start doing draws to the builder based off of the schedule that the builder did sign off on. And this is actually going to be extremely important because the builder has to agree to the schedule ahead of time, just so that we get to the point to where, in essence, he's not getting a check every week. He's going to be getting checks based off of milestones. And milestones being like, hey, we got the foundation in, so let's pay you for the foundation. Or, hey, we got the framing done. Or, hey, we got the roof on, or other things like that. Now, usually you want to keep it to about 6 to 10 six to 10 draws during the construction process because each one of these draws does cost money. It costs money because we have to verify that he's actually completed the process and it's not a wink, wink, I got it completed. It's actually that they did get it completed and that we can move forward with that. And so we'll send an inspector out, and then he'll take a look to make sure that it was done. We'll make any corrections based off of what he has or has not accomplished. And if everything is accomplished well, he'll get a full check. If he hasn't accomplished the full thing, then we're going to give him a percentage based off of what that completion ratio is. And so here's the construction process right here. Okay. If they start asking for a draw, then we're going to be working with them on each phase of how this works. And inspections are done at the completed phases. So, for example, if on Monday the builder submits a draw, you can see that over here in this corner. He's asking to get paid for a certain amount of money. You can see it right there. The inspection is then ordered through the construction team. Wednesday, we receive it and we draw up a request. Thursday, this is sent out for the borrowers. Notice that we're trying to keep the borrowers in the loop to make sure that they're not surprised that one of these things happens. And then Friday, the draw package is sent to the lender for review, and then the funds are wired to the wired to from us to the builder to pay him for his work. Now, the reason why this is important is as the loan grows, because it's a construction loan, the loan is working and based off of how much money is drawn. And they have two options. The buyer has two options, or the borrower has two options when it comes to making these payments, because you can either make payments as you're going along, which is what's a lot of lenders require is that they require that the buyer or the borrower make payments as they're going along, or what we do find as well is that in our case, we prefer to actually have the buyer roll their interest only payments into the loan. That way they don't have to double pay. Because many times what we find is that if they're having to pay for their current house or for a rental at the same point in time as they're having to make payments on the foundation, and then the next month it's the foundation and the framing, sometimes that can get a little overwhelming to the budget. And so many times what we prefer to do is just to roll those interest only payments into the loan. That way during the process, they don't have to worry about taking any payments on this. Instead, what they can do is that they can go ahead and they can just move forward like it's no big deal. But typically what would happen, most lenders do require that you make payments, interest only payments based off of how much has been drawn on the loan. Okay. Now, once we get to the end and the construction process is complete, this is where we convert the loan to the permanent mortgage. Now, construction is complete. You can see that over here in this corner. Construction is now complete. They've actually finished it. And now what we're going to do is we're going to go in and do a modification review. And so we're going to review the file. We're going to look at the interest rate for a possible float down. Okay, we do lock the interest rate up front. But what we're doing at the same point in time is looking at the market, because the market has been a little crazy the last couple months. And we've seen the rates come up, we've seen the rates come down. It's been sideways, it's been up, and it looks like it's currently on its way back down again. So we want to look at this and we want to look for any possible opportunities for improvement on the rate, because when we do this loan modification, we can float the rate down to be able to make this work. And then the file is going to be re-reviewed by underwriting to make sure the modification still works. So here's what that means when I'm saying that they're going to re-look at this, is that the buyer can't go out and buy furniture. They can't go out and buy a car that's going to look fantastic in that brand new driveway. They can't go out and buy all this or load up on credit, because in essence, we still have to make sure that everything happens in this process and it still works with the loan that we have them pre-approved for. If it doesn't, we're kind of in a little bit of a problem. And so that's kind of what we're trying to make sure that we deal with, is that understanding that we have to re-look at these things all the way up until they actually get the final closing on this, or it's actually done in the modification process. Because this process right here that you're seeing right here, if you were doing the two-time close, it wouldn't be a loan modification. Instead, it would be a refinance, where we would actually be refinancing this home into a permanent 5% mortgage, and that would give us the opportunity to look at the current rates as well. So those are both places that we look at them. Now, once everything is complete here, they're going to send the modification over to the title company, and the title company is literally going to get them to sign the modification, and then they're going to go down to the county courthouse right here, and they're going to get the loan modification done, and they're going to get it closed again, which is literally a very simple document and a very simple closing process. And then after that, we can go ahead and get the loan permanently with the end bank, the bank who's going to be taken over for the rest of the duration of that. And then after that, holy cow, they get to enjoy their home for many years. And there's some wonderful benefits when it comes to this because they have the opportunity to have built the home that they wanted, enjoyed the outcome of it. And yes, it can be a little, stressful along the way, but I'm going to tell you that most people who do go down the path of building one of these homes do find that it does work extremely well for them, especially because they got to customize the home and do it the way that they'd like to do it. Now, in the construction process, once the closing happens, so we're going to go back, we're taking a couple, we went a little too far, but in the construction process, we're going to be doing a couple of these pieces right here. So when we close on the specific loan, so we're going to take a step back here again, and we're just going to talk about what the construction process looks like. They're going to complete the closing on this right here, and then they have to commence construction within 30 days. So as soon as that's done. Once that happens, we're going to go ahead and call the buyer to make sure, the borrower in this case, to make sure that everything is going well and that everything is going the way it should be. And then as the builder submits draw request, we're going to be contacting the buyer periodically to make sure that the situation is working the way that they were expecting it to, and that they would be going ahead and getting the draw request, and that the buyer is actually confirming those pieces. Once the draws are processed, then in essence, the builder will go to the builder and then also to the buyer for the signatures so that they can move forward. And then once the builder is starting to close down, we're going to see that he's asking for the final draw request. And we'll notice that because we've been asking for updates along the way, and we're going to have in there, we're going to know how much money is left. And so we're going to be able to have a good opportunity to do check-ins to confirm if the construction is going along and is going to complete on time. Once that final draw request has been issued, because we're not going to give him the full amount until we can prove that the home has been completed. So he's going to issue this final draw request, and we're going to have to go through and inspect the property, and he won't get this final draw request until after the certificate of occupancy has been issued and the construction has been complete. So that's pretty much the construction process right there, and that kind of gets us through the general part of how one of these works. So as we start talking about this, there are several people that come to mind that we have helped in the past in a situation like this. We had a person who owned a home, and this was Roger. He owned a home, and he actually had he had to figure out a way to be able to get into this because he owned his previous home. His departing residence was going to be sold. He had a good part of it paid off. And so he needed a little bit to come up with the cash in order to be able to make this happen. And so we helped him get a home equity line so that he could actually take money out of the house that he was departing, use it for the down payment on the new house, rolled the interest only payments from the construction time because of the draws that were happening. He would have had to pay if we didn't do that. So we rolled in all that information so that during the draw request, he was actually making those payments directly to the interest only payment that he would be having with the bank. And then at the end, when it was all said and done, and the modification process right here, that's when he was finally, everything was rolled over. He had sold his home by this point in time, and it was just a matter of moving into his next house. And he had sold it to make it all happen. And then his final draw request worked very well for him, and it was a great turning over of the property for him. And he closed on the new house and was able to move out of the old house, and it worked fairly seamlessly for him. So, you have a question?
I did. Earlier, when we talked about interest payments and you said it was rolled into the loan.
Hmm.
So for me, does that mean that the borrower is not making payments during that time because they've already been taken out?
That's
or
correct.
allotted for, so he's not being troubled with having, oh, I forgot to make.
That's
Okay, and
correct.
you
Yeah.
guys just take care of that. Okay, gotcha. Understood.
Yeah, and that's the way we prefer to do it. Not every lender does it that way. At the last
I
company,
think that's the best way.
yeah, well, I think it's the best way too. But at the last lender that I was at, several, they did not do it that way.
Understood.
They require them to make monthly payments based off of the money that had been drawn. And the way that we do it is actually, I feel like very user friendly because, like in the case with Roger here, in his case, he wouldn't have been in a ton of a pinch to have to make not only his primary mortgage, his home equity line mortgage, but in the third mortgage, which is the construction loan. But it certainly was a kind of an exercise in redundancy to have to make all those extra payments like that. And so in this
Understood.
case, for him, it made life a whole lot simpler, and all he had to do was show up towards closing at the end. Mhm.
Understood. Thanks, Chris. Appreciate it.
Yeah. All right. So pretty much this is kind of the process when it comes to, building your own home. Now, there are some other nuances that we could go through when it comes to this. Are there any other questions that maybe I didn't address during the process that somebody might be interested in hearing a little bit more about? Okay, all right. So then, really, at this point in time, I'm going to be loading, like right now, I'm actually recording this. This is going to be going onto my YouTube channel later tonight. I do have a bunch of other videos on there related to different items, whether it's like, for example, in a few more weeks, we're going to be having an Ask the Underwriter, and he's going to be talking about items that are in people's minds when it comes to buying a home. And so, if you want to join in on that, you'll see this right here on my YouTube channel, and you'll be able to take a chance to be a part of that. Or you can come to the veterans one that I'm going to be doing in a couple of weeks as well. We're going to be talking about veterans and the opportunity to maximize their veterans loan. These are all great opportunities to help people get the process. Now, the reason why I do this is because of this. I actually prefer to work this way because a lot of my competitors spend all of their time cold calling and buying leads or doing other things like that, whereas I prefer to do it slightly differently than this. And I prefer to work by referral, and there's a whole bunch of different pieces on here, but referrals are the backbone of my business. And I want to make sure that my relationships are deep with the people that I'm working with, and I'm very helpful with them throughout the process. And so for me, you're the backbone of my business, and I want to help you. I want to help you get across the finish line for you as a client or you as the referral partner. And so these are very important pieces to me. And so I believe in service before, during, and after each transaction. And I have some very distinct core values that I'd like to inject into these, which is I want to make sure that you have high transparency as you're going through the process and that you understand what it is that you're getting into, that you have a high sense of understanding of what we're doing. So we want to take care of you through what we call high touch. And then at the end, what we're really trying to do is make sure that we're building trust with you so that when we talk to you about the process and what we're building, you have a confidence that we're actually working for you and helping you get there. I don't really have a ton of other items here. I just want to serve you and your clients, or you if you are looking to build or buy. And so, are there any questions that maybe I haven't covered that you would like to hear more about? Okay, well, then here we go. Thank you so much for coming out tonight, and it's been a pleasure and an honor. And I would certainly love the opportunity to serve you and your clients, or you if you're looking to buy or build in the near future. So, thank you so much for the opportunity.
Great.
Thank you,
Thank you,
Chris.
Chris.
All right,
Thank you,
thanks for
Chris.
coming. All right,
Excellent.
have a great evening.
Bye. Bye, Patricia. Nice
Bye.
seeing you here.
Same.